As a dividend growth investor, I like to invest in companies that provide me a reliable stream of income during good and bad times. One way to determine if a company will be able to do that is to look at their debt. In today's video, I will analyze 5 dividend aristocrats with low debt that I think are able to withstand the current recession. Hi, and welcome to the Dividend Attitude Show. I am Tom. The 5 dividend aristocrats that we will analyze today are Hormel, BancFirst Corporation, Medtronic, Roper Technologies. Be sure to listen until the end because at the end of the video I will give you 7 more dividend aristocrats to check out with low debt. Let's get started. First up is Hormel. Hormel is a food producer for a wide range of customers such as grocery stores, retail, deli and commercial customers in the US and internationally. More than 90% of Hormel's products are sold in North America and a large portion of that is grocery stores. Hormel produces many iconic brands such as Spam, Dinty Moore, Holy Guacamole, Jenny O Turkey and of course Skippy Peanut Butter. Although if you want to taste real peanut butter, you should taste the Dutch one. Hormel is an iconic company that has already been around for more than 125 years. 40 of their brands are either the first or second brand in their category. They enjoy a wide moat in terms of economies of scale and a high barrier to entry. Hormel is part of the consumer staple sector. With their 54 years of dividend growth, Hormel is not only a dividend aristocrat, but also part of the Dividend Kings Club. Their earnings payout ratio is currently a bit over 56%, and the free cash flow payout ratio is at almost 60%. Both are a bit on the higher side, but for such a stable company, nothing to worry about yet. What I do not like so much is that it seems their payout ratio has been creeping up quite a bit, with a low of about 36% at the beginning of 2017 to now nearing 60%. For a dividend king, the dividend growth rate is absolutely amazing with a 10-year dividend growth rate of 16%, and 1, 3 and 5 year growth rate are all well into the double digits. As you can see in the dividend history graph of Hormel, it is showing a nice steep staircase pattern. The stability of Hormel is also represented in their dividend safety score of 99 on Simply Safe Dividends. The Simply Safe Dividends website defends their dividend safety by touting their low debt, consistent free cash flow generation, and their ability to keep raising their dividends for so long. Hormel is also a typical recession-proof stock, which only lost 15% during the Great Recession of 2008, compared to 55% of the overall market. They have been able to grow their revenue from 7.2 billion in 2010 to 9.5 billion in 2019, for a growth rate of almost 3.2% per year. So that is not supporting their dividend growth, but looking at the earnings growth of over 11% in the last 10 years, it is very much in line with the dividend growth. The free cash flow of Hormel went from 0.74 in 2010 to 1.41 in 2019, so almost double in 10 years. And now the focus of these selected dividend aristocrats, their low debt. Hormel had a debt to equity ratio of 0 in 2010 because there was no long-term debt. In 2019 they reported a debt to equity ratio of 0.04, and from their latest quarterly report you can see that their debt to equity ratio dropped to 0.01. They can pay their long-term debt off 10 times over with their current cash position. The S&P credit rating should come as no surprise and stands at A. The return on equity is almost 17% and is at the midpoint of their 10-year average. Looking at the return on equity on Finbox for some of their competitors, 3 have a higher return on equity, with Hershey being the absolute outlier with 72.4%. The return on invested capital is 15.6% and a bit on the lower end of the 10-year average. Compared to their competitors, only Hershey scores better with a return on invested capital of 18.7%. The operating margin is very stable and stands at 12.2%, on the higher end of their 10-year average. Only Flour Foods is scoring worse than Hormel on the operating margin, but the fact that it's so stable is a good sign. If you liked the video so far, don't forget to hit that little thumb and make it turn blue. Also don't forget to subscribe if you want to get updated when a future video comes out. It will greatly help to get my content out to more people. For those of you who have already liked and subscribed, thank you so much. BancFirst Corporation is a regional bank chain in Oklahoma that offers commercial banking services to retail customers and small to medium-sized businesses. They offer a wide array of products like different kinds of bank accounts, loan services, investment advisory services, and so on. BancFirst is divided into 5 business segments: metropolitan banks, community banks, Pegasus Bank, other financial services, executive operations and support. BancFirst is part of the financial sector. BancFirst became an aristocrat 2 years ago and has raised its dividend for 27 years. The earnings payout ratio is 42% and has been quite range bound between 35 and 45% in the last few years. The free cash flow payout ratio stands at 37%, but because the operations of a bank are tightly related to interest rates, investments and debt, it is better to look at the earnings payout ratio for banks. 10-year dividend growth rate stands at 10.7% with the 3 and 5-year dividend growth rate quite a bit higher, but the 1-year dividend growth rate lower at 7%. One thing worth noting is that in 2018 they raised their dividends at almost 43%. Oh my, imagine if you are a shareholder and they announce a 43% dividend increase. From a dividend safety standpoint, BancFirst is another rock solid dividend growth stock with a dividend safety score of 99. The revenue of BancFirst went from 0.2 billion in 2010 to 0.41 billion in 2019, or a growth rate of 7.7%. So revenue-wise, this company is probably the smallest I have analyzed from the Dividend aristocrats list so far. The free cash flow went from 3.94 in 2010 to 3.32 in 2019. But like I mentioned before, for banks it is better to look at the earnings rather than the free cash flow. The debt to equity of BancFirst went from 0.14 in 2010 to 0.03 in 2019. As with Hormel, they have enough cash on their balance sheet to pay off their long-term debt almost 10 times over. I couldn't find a credit rating for BancFirst. The return on equity of BancFirst stands at 14.14%, which is on the high end of their 10-year average. Compared to their competitors, BancFirst is doing very well based on the return on equity. In fact, they have the highest return on equity in this group. I personally was curious how they lined up with another regional bank I recently checked out, which is the Bank of the Ozarks. Also OZK has a low return on equity of 10.8%. There's no return on invested capital for BancFirst, which is quite logical because for banks, since most of their funding comes from deposits made by their customers. So return on invested capital is not a meaningful metric to look at for banks. The same applies to the operating margin. This is not a meaningful metric to look at for banks because the interest is a core component of their revenue and expenses. There are a couple of interesting things to note about BancFirst. Right now they seem to offer a rare combination of highish current dividend yield, high dividend growth, on the surface very good financials, and they seem to be undervalued looking at their current dividend yield compared to their historical yield, and they seem to be undervalued based on the data of fast graphs. Medtronic is one of the largest medical equipment manufacturers in the world. They sell device-based medical therapies to hospitals, clinics and patients all over the world. Medtronic is divided up into 4 business segments: Cardiac and Vascular Group, Minimally Invasive Therapies Group, Restorative Therapies Group and Diabetes Group, where the diabetes segment is by far the smallest segment, representing only 7% of their total revenue. Medtronic is part of the healthcare sector. With a dividend growth streak of 43 years, Medtronic is well on its way to become a dividend king. In the midst of this crisis, Medtronic has actually recently announced a dividend raise of 7.4%. Because their recent earnings had a significant drop due to less demand for non-critical surgeries, and their dividend increased, the earnings payout ratio now stands at 63.6%, which is a significant spike from their previous 40ish payout ratio. Based on the free cash flow of fiscal year 2020, which ended in April, their free cash flow payout ratio is 43.8%, so looking a lot better there, but that only includes a few months into the current crisis. The 10-year dividend growth rate stands at a nice 13.5%, the 3 and 5-year dividend growth rate are a bit lower, and I think the 1-year dividend growth rate is a glitch on seeking alpha, because their recent increase was nowhere near the 42% showing here. Medtronic is the 3rd company in a row in this video with a dividend safety score of 99. Though there might be some short-term struggles ahead, long-term the future of Medtronic is still looking very bright. Management expects an average earnings growth in the mid to high single digits over the next 2 years. Medtronic is also a very diverse and financially healthy company, which helps them navigate these rough times. The revenue of Medtronic grew from 15.9 billion in fiscal year 2011 to 28.9 billion in 2020, for an average growth rate of 7.6%. As noted, the revenue did decline in fiscal year 2020 due to less surgeries. Medtronic showed a nice free cash flow growth with a free cash flow per share of 3.27 in 2010 and a 4.93 in 2019. But as you can see in the graph, there was a big dip in between, but the dividend was well covered all this time. The debt to equity of Medtronic is a bit higher than the previous 2 dividend aristocrats, but with a ratio of 0.51 in 2011 and a debt to equity ratio of 0.43 in 2020, there's nothing to worry about. In contrast to many companies, their debt to equity ratio actually declined. The S&P credit rating of Medtronic is also an assuring A. The return on equity for Medtronic is a tad under my threshold of 10% with 9.5% and is on the lower end of their 10-year average. Compared to competitors, Medtronic is right in the middle with 3 companies having higher and 3 companies having a lower return on equity. The return on invested capital is 7.4 and is also on the lower end of their 10-year average. However, only Stryker is doing better with a return on invested capital of 11.2%. If you want to see an analysis of Stryker as well, I analyzed them in episode 20, which is now suggested in the top right corner. Operating margin is 18.2% and is the lowest in 10 years. Of their competitors, only Stryker and Teleflex are doing better. Roper Technologies designs and develops software and engineered products all over the world. They have a very wide array of products such as campus solutions, laboratory information management, enterprise management, up to visual effects and 3D content software. This amount of diversification can be both a blessing and a curse, for the company itself and for investors. For the company it will be hard to compete and innovate on all fronts, and for investors it is hard to gauge the risks and really understand what the company is all about. Roper Technologies is part of the industrial sector. Roper Technologies has raised their dividends for 27 years in a row now, with a very low current earnings payout ratio of 16.8%. Their free cash flow payout ratio is even lower at 13.9%. With a 10-year dividend growth rate of 18.8%, they are a fast dividend grower. However, the 1-year dividend growth rate is a bit lower at 11%. This is a pure low-yield, fast dividend growth company with a current yield of 0.52%, which based on their 5-year average yield is pointing towards overvaluation. The first company to break the streak of a safety score of 99, but still at 98, which is of course very good. Roper's revenue growth explains some of that overvaluation because it grew from 2.4 billion in 2010 to 5.4 billion in 2019 for an average growth rate of 9.6%, but the most recent year-over-year growth was only 3.4%. Of this group, Roper has the best dividend coverage based on free cash flow, and it grew tremendously from 4.87 in 2010 to 13.28 in 2019. The debt to equity had quite some swings in the middle, but from 0.45 in 2010 to the 0.49 in 2019 it went only up a little. With a credit rating of BBB+, it has the lowest credit rating of all 5 dividend aristocrats mentioned in this video. The return on equity is 20.2% and is at its highest point in 10 years. Of their peers, only Graco is higher with 35%. It is worth noting though that with such diverse companies as Roper, it is hard to really compare them to competitors. Return on invested capital stands at 13.9%, again the highest it has been in 10 years, and again only Graco is scoring higher with 22.7%. Operating margin is also on the higher end of the 10-year average with 27.9%, which is the highest in its peer group. Roper is one of those companies that seems to be overvalued most of the time. Some other dividend aristocrats to consider with low debt are AOS. I've already analyzed this company in episode 20, which is now suggested at the top right. Erie, Xam, CVX, TR, T-Rowe, J&J. Both T-Rowe and J&J were already analyzed in episode 16, now suggested in the top right corner. You might have noticed that recently I've started to upload videos every Friday, and that will be the regular upload day of the week, so keep an eye out for a new video every Friday. If you would like to get notified when a new video comes out, don't forget to subscribe and turn the notification bell on. Also, don't forget to like the video if you came this far, because it obviously means you like the content. Also check out the other videos I made on dividend aristocrats, which I have put in a playlist for you that you can click on in the top right corner. See you next week, bye bye.